Hi there, welcome back. This is the E.M.I for the month of April 2026. So let's jump right in. In this month's E.M.I, as usual, we ask a few questions and make some observations. Why did India 10-year yields witness a sharp surge in March? We noticed that growth in key industry metrics were seen holding up, as was rural sentiment. Capital account continued to remain in focus, and its ability to finance the current account had weakened. We take a quick peek into global domestic returns, flows, market cap to GDP, and much more. On investing, we see how long it would take a rupees 10,000 SIP to touch rupees 1 crore. And we also see how long a rupees 10,000 SIP has been able to touch rupees 1 crore in the past few decades. March saw a sharp surge in India 10-year yields due to rupee and crude. India 10-year yields rose 40 basis points in March 2026, last month, closing the month at 7.1%, its highest in nearly 2 years. We have written multiple times in the past about the close relationship of India 10-year yields with that of the rupee, crude, and domestic liquidity. One must note here that the last 12 months have witnessed 10-year yields move closely alongside the movement of the rupee. The 10-year yields movement with crude witnessed a pause since the US-Israel-Iran conflict began, but by end March 2026 appears to have caught up all over again. Given that the RBI is keeping liquidity at comfortable levels, remember here that incremental moves on the India 10-year yields would now be fairly dependent on the movement of crude prices and the rupee. Debt markets are always forward-looking, and quoting our research from last year, we saw that on average they tend to predict RBI policy rate moves nearly a year in advance. Let's now take a quick look at how some key short frequency macro indicators looked like. Manufacturing PMI dropped sharper than services in March on geopolitical uncertainty. RBI's measures around the rupee late March appears to have helped contain volatility to some extent. Truck freight rates broadly seen range bound except for the Chennai leg. Industry growth was seen holding up, seen in cement production growth, steel production growth, and 8 core industry growth on the whole. Rural sentiment was seen holding up fairly well. Tractor sales growth probably was witnessing normalization after a phase of stellar growth, and two-wheeler sales growth continued to surge on strong rural and urban demand. India's current account deficit for December 2025, latest data, was seen moderating on higher invisibles, but the capital account that finances the current account was seen fairly weak with outflows. Let us now shift to the markets. But before we take a look at returns and valuations, let's see how the Nifty performed in March. The Nifty contracted by 11.3% during the month in rupee terms, dominated by global geopolitical dynamics. Take a look. March equity returns were completely off historical averages, as you can see in this heat map. Indian markets saw metals, energy, and pharma top the outperformer list in March, while realty and IT were underperformers. FIIs sold sharply in March, while 2026 YTD saw DIIs continue to remain strong net buyers. Here is a look at how the key cap curves stack up historically, and we can also see here how the markets have fared during this current drawdown phase. large, mid, small cap valuations have inched lower and large cap has moved below long-term averages. Where does the golden metric of market capitalization to GDP stand now? It stands at 119% and continues to moderate. Commodities were top performers in March globally. Singapore and Brazil topped their respective regions on a 3-month basis. China's outperformance over India continues in brief, short waves, largely on India underperformance. Now we come to the last segment of E.M.I, what must you know before investing? We look at two key questions that have captured the imagination of most investors and try to measure how and when to get there. When will my portfolio touch rupees 1 crore? To answer this question, we take an investor investing in a systematic investment plan or SIP of rupees 10,000 every month. We also assume a realistic 12% CAGR return. An SIP of 10,000 per month started in December 1999, crosses rupees 1 crore in 2019. It crosses rupees 2 crore in 2025 and crosses rupees 5 crore in 2032. What is important to note here is that it takes just over 20 years to make the first rupees 1 crore, but takes lesser and lesser time to make every additional crore. What will happen if you increase the monthly SIP to, let's say, 20,000 per month? Now, this helps achieve these milestones much faster. For example, rupees 20,000 per month SIP reaches rupees 1 crore 5 years earlier than a 10,000 SIP at these assumed CAGR rates of 12%. This highlights the importance of investing for a longer time horizon and, most importantly, to allow the portfolio to reach critical mass such that it is able to grow at a faster clip. Now the second question. How long has it taken a 10,000 SIP to touch 1 crore in the past? To answer this question, we take what an SIP investor would have received in reality if he had invested or she had invested in a 10,000 rupee SIP per month in the Nifty Total Return Index. An SIP of 10,000 per month started in December 1999, crosses rupees 1 crore in 2017. And this is 2 years earlier than our previous example. And this implies that the markets in reality delivered a faster rate of return than the 12% we assumed in our previous example. The additional 1 crore was reached in 2022, in 4.9 years, slightly earlier than 5.4 years it took in our earlier example. Till next time, this is Arjun signing off.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.